Building a $100,000 stock portfolio might seem impossible when you're starting from zero. But here's the reality. It's not about having a high income or getting lucky with individual stocks. It's about understanding the math of consistent investing and letting compound growth do the heavy lifting. Most people think they need to save $100,000 to have a $100,000 portfolio, but that's not how investing works. If you invest $500 monthly and earn 8% annual returns, you'll reach $100,000 in just 12 years. Increase that to $750 monthly, and you'll hit six figures in under 9 years. Today, I'm walking you through the exact step-by-step process to build your first 100K stock portfolio from scratch. We'll cover how much you need to invest monthly at different return rates, the best investment strategies for beginners, and the specific milestones you should hit along the way. By the end of this video, you'll have a clear roadmap to six-figure wealth through stock market investing, regardless of your starting point. Hit that subscribe button because I'm sharing wealth-building strategies every week that can transform your financial future. Let's start with the numbers, because understanding the math will motivate you to take action. Here's how long it takes to reach $100,000 at different monthly investment amounts, assuming 8% annual returns. $300 monthly, 18.5 years. $500 monthly, 12.2 years. $750 monthly, 9.2 years. $1,000 monthly, 7.5 years. $1,500 monthly, 5.5 years. Notice that doubling your monthly investment doesn't just cut the timeline in half, it cuts it by much more due to compound growth. This is why increasing your savings rate is the fastest way to accelerate your wealth building. Even if you can only start with $100 monthly, that's $100,000 in about 30 years. The key is starting now and increasing contributions as your income grows. Step 1. Open the right investment account. Your first decision is choosing between a taxable brokerage account or tax-advantaged retirement accounts like IRAs and 401ks. For retirement investing, max out your 401k match first. That's free money. Then contribute to a Roth IRA if you're eligible. $7,000 annual limit for 2024. Roth contributions are made with after-tax dollars, but all growth and withdrawals in retirement are completely tax-free. For general investing, use a taxable brokerage account that gives you access to your money anytime without penalties. Best platforms? Fidelity, Charles Schwab, and Vanguard offer commission-free stock trades, excellent research tools, and low-cost index funds. I personally use Fidelity for their zero-fee index funds and user-friendly interface. Set up automatic monthly transfers from your checking account to remove the temptation to spend the money elsewhere. Step 2. Choose your investment strategy. For building your first 100K, keep it simple with broad market index funds rather than trying to pick individual stocks. Index funds provide instant diversification, professional management, and historically strong returns. My recommended starter portfolio: 70% total stock market index, XZROX at Fidelity or VTI, 20% international stock index, FTIHX at Fidelity or VTI-AX, 10% bond index, FXNAX at Fidelity or BND. This allocation provides global diversification with growth focus appropriate for long-term wealth building. As you approach 100K, you might adjust allocations based on your timeline and risk tolerance. Why index funds beat stock picking? Over 90% of professional fund managers fail to beat index funds over 15-year periods. Index funds are cheaper, more diversified, and remove the need to research individual companies. Step 3. Automate your investments. Automation is crucial for reaching 100K because it removes emotion and ensures consistency. Set up automatic monthly investments on the same day each month, preferably right after payday. Dollar cost averaging means buying the same dollar amount regardless of market conditions. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this smooths out your average purchase price and reduces timing risk. Most people fail at investing, not because they choose bad investments, but because they stop investing during market downturns. Automation prevents this mistake by continuing to buy during scary market periods when stocks are actually cheaper. Step 4. Increase contributions systematically. Starting small is fine, but reaching 100K faster requires increasing your investment amounts over time. Here are proven strategies. Annual increases. Increase your monthly contribution by $50 to $100 each year. If you start with $300 monthly and increase by $100 annually, you'll reach 100K in about 8 years instead of 18. Raise-based increases. When you get a salary increase, immediately boost your investment contribution by 50% of the raise amount. If you get a $2,000 annual raise, increase monthly investing by $83. Windfall investing. Invest tax refunds, bonuses, and other windfalls. A $3,000 annual tax refund invested over 10 years could add $25,000 plus to your portfolio through compound growth. Side hustle income. Use income from freelancing, part-time work, or selling items to boost your monthly contributions rather than lifestyle inflation. Breaking $100,000 into smaller milestones keeps you motivated and helps you stay on track. $1,000, your first milestone, proves you can stick with investing. $10,000, first major milestone where compound growth becomes noticeable. $25,000. Quarter of the way there, growth really starts accelerating. $50,000, halfway point where you're earning significant investment income. $75,000, 3/4 there. The final push becomes exciting. $100,000, mission accomplished. But don't stop here. Celebrate each milestone to maintain motivation, but avoid the temptation to withdraw money for celebrations. The power of compound growth means your second 100K will come much faster than your first. Then you will experience market crashes on your journey to 100K. The stock market typically falls 20% plus every few years, and 50% plus crashes happen occasionally. Here's how to handle volatility. Don't panic sell. Every major market crash in history has been temporary. Selling during crashes locks in losses permanently and prevents you from participating in the recovery. Keep investing. Market crashes are buying opportunities. Your monthly contributions buy more shares when prices are low, accelerating your wealth building when markets recover. Focus on shares, not dollars. During downturns, focus on accumulating more shares rather than portfolio value. Those extra shares purchased at low prices will be extremely valuable during the next bull market. Trying to time the market, waiting for the perfect time to invest, means missing months or years of compound growth. Time in the market beats timing the market. Chasing hot stocks. Individual stock picking rarely beats diversified index funds and often leads to significant losses that set back your timeline. Stopping during downturns. Many people pause investing during bear markets, missing the best buying opportunities and recovery gains. Not increasing contributions. Starting with small amounts is fine, but not growing your contributions as your income increases dramatically extends your timeline. Lifestyle inflation. Increasing spending with every raise prevents you from increasing investments. Here's what's exciting. Reaching your first 100K is the hardest part. Your second 100K will come much faster due to compound growth. If you're investing $1,000 monthly, earning 8% returns, your first 100K takes 7.5 years. Your second 100K takes just 4.5 additional years. Your third 100K takes only 3.5 more years. This acceleration happens because you're earning investment returns on increasingly larger amounts. At 100K, an 8% return generates $8,000 annually. At 200K, that same return generates $16,000. Reaching 100K isn't the finish line. It's the foundation for serious wealth building. Once you hit 6 figures, consider increasing allocations to growth investments if you have long time horizons, adding international and emerging market exposure for better diversification, exploring dividend-focused strategies for income generation, considering individual stock positions if you want to research specific companies. But remember, the same principles that got you to 100K, consistent investing, broad diversification, and long-term thinking, will continue serving you well. Building a 100K stock portfolio from scratch isn't about getting rich quick. It's about getting rich predictably through consistent investing and compound growth. The exact timeline depends on how much you can invest monthly, but the process remains the same. Start investing, automate everything, stay consistent through market volatility, and increase contributions over time. The most important step is starting, even with small amounts. Every month you delay pushes back your 100K timeline, while every dollar you invest today has maximum time to compound. Your first 100K will change your entire relationship with money and investing. It proves that building wealth is possible and gives you the foundation for even bigger goals. What's your current monthly investment amount? And when do you plan to reach 100K? Let me know in the comments. And if this roadmap motivated you to start or increase your investing, hit that like button and subscribe for more wealth building strategies. Remember, the best time to start investing was yesterday. The second best time is right now.